The economic storm clouds in the economy are building bigger and bigger in 2024, which will eventually force the Federal Reserve to do an emergency rate cut over the next couple months in response to a worsening recession and economic crisis. I say this not to scare anyone out there, but to simply give you guys the facts about what I am seeing transpire in the economy right now, which is a combination of a worsening job market with lots of layoffs, a crashing commercial property sector where values are down by as much as 50%, and perhaps most importantly, a looming banking crisis, which could already be underway. With Bloomberg reporting that there's a $560 billion property warning now hitting banks from New York to Tokyo, with Deutsche Bank now warning of U.S. property losses and New York Community Bank now being in a rout after a horrible earnings report. Lots of problems now are showing up in the banking sector, so let's explore what's going on so you guys can be informed. So what basically Bloomberg is saying here is there's $560 billion in maturing commercial real estate debt that's now causing problems for international banks. New York Community Bank Corp and a bank in Japan just delivered a reminder that some of these lenders are just starting to feel the pain. Shares of New York Community Bank Corp plunged 38% earlier this week, dragging the shares of the firm to a 23-year low as they reported higher property losses. Now, at the same time, Tokyo-based Ozora Bank plunged more than 20% after warning of U.S. commercial property losses, while Deutsche Bank more than quadrupled its U.S. real estate loss provisions. And ultimately, what this is, folks, it's a sign that the commercial property crash, which I've been talking about over the last 3 to 6 months, is now finally starting to take hold and impact the banking sector, which could be a big problem for the economy, because ultimately these commercial banks, they run the economy. If the banks are lending money out in the economy and pushing money into the economy, things will go well. Conversely, if the banks start losing money and have to cut their lending and a credit crisis unfolds, that's the recipe for a big recession. That's what happened back in 2008. That's what happened during the Great Depression. And the big risk here is that as 2024 unfolds, these banks are going to take even more losses on their balance sheet from their commercial real estate loan exposure, which is going to cause a worsening recession. And I'm going to get more into details about this kind of worsening recession and what it could mean for the economy and the job market and the housing market in a second. But first, I want you guys to understand the gravity of the issue going on right now in the commercial property sector. We have values of commercial properties in America, which include office buildings, apartment buildings, retail strip centers, hotels, industrial warehouses. The values of these assets are plummeting right now, with the Green Street Commercial Property Price Index showing that commercial values in America are now down by over 20% from their peak. So you can see the values now exiting January 2024 at index level of 121, which is basically the lowest level it has been since 2015, with drops occurring across all asset classes, but particularly office. Office buildings are down 35% from peak. Obviously, there's a huge issue with work from home, declining office occupancy rates, which are causing big drops in value. But additionally, folks, apartment buildings are down 30% in value. That's one that I think a lot of people watching might be surprised about, because the apartment buildings don't have the same vacancy issues that the office buildings have, yet the values are dropping a lot due to higher interest rates. At the same time, we can see retail strip centers are down by 18% in value. Malls are down by 20% in value. Self-storage facilities are down by 21% in value. And so the immediate issue here for these declining values is for the owners of these buildings, the big landlords that own the tall office towers and the big apartment buildings. They are taking a beating right now. Because if they go to sell their property or refinance their property, it's now worth 30% less, or maybe even 40% less. Or if you're in downtown San Francisco, we're seeing properties sell for 80% less than what they used to be. There's a fire sale going on right now in the San Francisco office market, which, yeah, it's bad for the developers and the owners, but it's also really bad for the banks, because the banks loaned out the money on these properties, right? The banks have lots of exposure too. So if the values go down 30 to 40%, all of a sudden the loans are underwater. The loans are underwater, and the bank now needs to write down the value of these loans. And in more and more cases, they're going to have to take over the property and foreclose on it. And that's where we're starting to see the issues bubble up to the surface, particularly with New York Community Bank, whose stock just plunged by 40% according to the Wall Street Journal, reigniting fears for regional banks. Now, New York Community Bank, you guys might not have heard of them. I actually hadn't heard of them, but they are the 34th largest bank in America. They're actually bigger in America than Deutsche Bank, Comerica. They're bigger than Raymond James. They're bigger than CIBC. So they're not small. They have over 100 billion in assets, and their stock is now in free fall, down by 40% over the last week. And the reason New York Community Bank stock is in free fall is because during their earnings report, they reported a huge surge in credit losses due to bad commercial real estate loans on their balance sheet. And this was really kind of like the first instance of one of these banks, reporting the huge losses. This has been something people have been like theorizing and talking about, like, the commercial real estate crash is going to cause issues for the banks. Well, New York Community Bank is like the first one to really show proof in the pudding. You can see here, if we look at their income statement, I want to show you guys this. This was what freaked everyone out. It was this section called provision for credit losses. You can see last year they had 124 million earmarked for credit losses. This year they had 552 million earmarked for credit losses due to these bad loans, these bad commercial real estate loans, a 345% increase year over year. This provision for credit losses ultimately caused the bank to lose 260 million on the quarter after making 164 million a year ago. So a minus 260% swing in earnings. This was a complete shock and surprise, which is why the stock is declining, which is why many people are now fearful that the banking crisis, that maybe started a year ago with some of those banks that went under, might not be over. Now, of course, there are some people who are saying this is no big deal. You look out on the news and you're seeing the CEOs of other large banks like Bank of America and Citizens. They're saying this is an outlier. They're saying New York Community Bank, don't worry about them. Like, that's not indicative of the broader market. The CEO of Citizens Bank is saying, for the most part, everything's in the rearview mirror. He's saying things are starting to feel more normal. Yesterday's announcement, bit of a surprise. It's an outlier. CEO of Citizens Bank is saying, no big deal. Don't freak out. But I don't know, everyone. I think the writing is on the wall that this is going to get worse. Because commercial banks in America hold nearly $3 trillion of commercial real estate loans. That's right. $3 trillion in commercial real estate loans are on U.S. bank balance sheets right now, and a majority of those loans, over 2/3, are with small regional banks. So it's small regional banks that are most in the crosshairs of this. And when you look at the declines in property values I showed you earlier, like, obviously there's going to be more pain in the banking sector from this commercial property crash. This $3 trillion in commercial real estate loans, it's way higher than it was just 5 or 6 years ago. It's up by over 50% when the values of commercial properties, folks, are back to the level they were in 2015, suggesting that the value of these commercial real estate loans is going to go down into the future. And again, the way that this will translate into impacting the broader economy and why this matters for you out there is that this is going to be potentially a big problem for the economy. Because if the banks have to do big provisions for credit losses and their incomes go down because of it, they're going to restrict lending into the economy, and the financial system could freak out and we could have a massive credit crunch. That's kind of how the chessboard could play out. And if we have this massive credit crunch, that could be a trigger for the mass layoffs and the increase in the unemployment rate that a lot of people have been predicting and waiting for. And speaking of layoffs, like, over the last month, we've seen a huge surge in the amount of corporations announcing layoffs. I did a video a couple weeks ago talking about Google and Wayfair and Citibank. Since then, we've seen even more layoffs. UPS now announcing 12,000 job cuts. UPS cutting 12,000 jobs after it says package volume slipped last quarter. Their revenue declined by 8%. I mean, folks, like UPS, they're one of the biggest shipping companies in America. The revenue dropped by 8%. They're laying off 12,000 people. That's a tough sign for the economy. It flows through also with problems that FedEx is also having, which I also talked about on this channel about a month ago. There's a broader shipping recession. There's a freight recession going on across the world, with Maersk, one of the largest shipping companies in the world, announcing 10,000 job cuts as well at the end of last year. Maersk is a company that ships a lot of the heavy freight all around the world, the goods coming from China to America. Well, Maersk is having big problems as well. So we have this big turmoil in the shipping and freight industry. Of course, we also have huge layoffs in the tech and financial sector. And more broadly, it seems like maybe these layoffs also could be starting to spread to other industries and sectors. sectors, with Bloomberg reporting that U.S. jobless claims rise to 2-month high as labor market cools, with initial applications jumping unexpectedly to 224,000. Now, this level of unemployment applications for people who lost their job and want to go on welfare, this is a historically low level of unemployment applications, but it's rising significantly over the last several weeks, which suggests that the labor market might be on the precipice of a larger deterioration where we could see the unemployment rate go up. Something that could make life very difficult for Jerome Powell and the Federal Reserve. Kind of now getting to the original crux of the video that I introduced in the beginning. What's the Fed gonna do in light of all of these headwinds that are now piling up with the commercial property crash and issues in the banking sector, and now the labor market really starting to soften? Is the Federal Reserve going to be forced to do emergency rate cuts over the next several months and greatly reduce the interest rate? Well, according to Jerome Powell, that's actually not going to happen. Jerome Powell just had a press conference the other day, and he came out and said that the Federal Reserve is holding rates steady and indicates it is not ready to start cutting. The Federal Reserve sent a tepid signal that it is done raising rates, but made it clear it is not ready to start cutting rates. Jerome Powell saying that the committee does not expect it to be appropriate to reduce the target range of the federal funds rate until it has gained greater confidence that inflation is moving sustainably towards 2%, making a March rate cut unlikely. And so a lot of people, they were banking on that March rate cut from the Federal Reserve in a couple months. It looks like, based on what the Fed is saying, that that's unlikely to happen, meaning that maybe we see the first rate cut in May. However, what's interesting is that the bond market and the treasury market is reacting in a very strange way to what Jerome Powell said. This is something you guys need to pay attention to. You would think that, based off what Powell said, that interest rates would hold stable across the yield curve or even go up, because the Federal Reserve came off as more hawkish than people expected. However, that's not what happened. Instead, interest rates and mortgage rates dropped by quite a bit after the Fed press conference, with the 10-year U.S. Treasury yield falling from about 4.15% to 3.9%. So that's a pretty big reduction in the long-term U.S. Treasury yield. Now ultimately pushed mortgage rates back down from 6.9% to 6.6%. So folks, this is strange. Powell said he's not going to cut, but the market participants are almost acting as if a rate cut is more likely. And I suspect the reason that's happening is because of the issues growing in the banking sector. I think the news about New York Community Bank, as well as the bank in Japan, as well as Deutsche Bank, I think that's now freaked out the markets in the financial sector, which is now causing big banks, big traders to pile into U.S. Treasuries as a safe haven, which is pushing those yields down, even though Powell is saying we're not going to cut rates. Ultimately, it looks like the market is suggesting that Powell, you're saying you're not going to cut, but we think eventually you're going to be forced to cut. With the CME Fed Watch tool, which is a kind of a prediction tool for where interest rates are going, it's a betting market. They're now saying, all right, in March, there's 62% chance rates stay the same, 39% chance there's a cut. So they've increased the odds that rates stay the same. However, if you go out to December, they are still predicting in the betting markets that by December, the short-term interest rates are going to be around 3.8 to 4%. So the betting markets are still predicting that there's going to be 150 basis points of rate cuts, 1.5% rate cut through the end of 2024. And why would they do that? Well, it's because I think the market participants see the economy heading south. They see the issues in the financial sector, which suggests that at some point the Fed is going to be forced into doing emergency rate cuts. Regardless of what they say today, the idea is at some point the banking sector crisis is going to get worse, the layoffs are going to get worse, and the Fed's not going to have a choice. And one thing I just want to say to you guys, if you want to learn more about the housing market in the financial services sector, I want to encourage you to hit the join button below and become a channel member. The cost of doing that is $5 a month, and in return, you get access to exclusive videos where I provide detailed predictions on, where home prices are heading in 2024, which cities' prices will drop the most, as well as historical lessons and tutorials on how the economy and the housing market works. There's also a back catalog of these videos at this point that you can go and watch. In particular, I would recommend that you watch my 2024 housing market prediction video, where I cover the states and the cities where I think home prices are going to decline the most in 2024. You can see that video here on the screen right in front of you, so click it and inform yourself on the future direction of the housing market this year.